Uh, I would just take 2 or 3 minutes because I know long short is a complicated product, and sometimes clients are not fully able to distinguish between the various kinds of long short products which exist in the market. So once again, I would reiterate very briefly, just in about 2 or 3 minutes, 2 or 3 key features about our long short product Ambit 365. So it is a directional, um, it's a directional equities long short product focused on generating absolute. Yeah, so focused on generating absolute and consistent returns across market cycles. And the returns that we target is about 18% gross per annum, which works out to about 9%. So 18 to 20% gross.
Oh, I'm very sorry to interrupt you. We've got a couple of feedbacks that the voice is not very audible. So maybe a little bit louder.
Let me check my mic volume. Sometimes the mic volume is an issue. Yeah, the mic volume was low. Okay, can you just take the feedback on the chat if it's better now?
It is. Yeah.
Okay. Yeah, I don't know why Zoom keeps on resetting the mic volume to automatic levels, which never work. So I will restart. I will just roll back slightly. So I'll just spend 3 minutes before we dive into what we're thinking about the markets right now, how the portfolios are positioned into Ambit 365 product itself. So we are a directional equities long short product, aiming to generate absolute and consistent returns on a 12-month cycle across all market cycles. And our objective is to generate 18 to 20% gross, which will translate into 9 to 10% post-tax, post-fees returns for the clients. And since we are directional, we do take strong positions on which sectors will do well, which companies will do well, and try to generate alpha out of that. So expect a little bit higher volatility in our products as compared to market neutral products, but then those guys also generate only about 12 or 14% gross returns per annum. So what we guide is you could expect 2 or 3 down months from us in a year, 2 or 3 fantastic months from us in a year, and the balance 5 or 6 months should be more like average and consistent. And that's how we will add up to 18 to 20% gross returns. 3 key features of the product very quickly. How we do this. We have very clean compartments for exposure limits. So our total gross exposure we can take is 180%, which is divided into 2 buckets. 100 is kept for stocks and 80 is kept for Nifty. The strategy that we follow to construct a Nifty book and a stock book are uncorrelated with each other. So if the one book something goes wrong, the other book usually comes into rescue. Second, the stock book of 100 is further divided into maximum 50 for longs, maximum 50 for shorts, minimum 20 longs, minimum 20 shorts. We use a framework called sine curve, where we look for business acceleration and deceleration to divide our stock universe into longs and shorts. And Nifty, which is the third and the last point, we use a set of mechanical triggers to build our Nifty position. While we go up to 80% total exposure in Nifty, we always build it in tranches so that while I can see 3 Dheeraj Agarwals here, and one of the mic is crackling. I don't know why is that happening.
So I have muted all participants. You may want to unmute your mic now and check.
Yeah, now it's better.
Okay, great.
For some reason, I can see 4 Dheeraj Agarwals on my screen, and one of the Dheeraj Agarwal mic was making a noise. So I don't know why that is happening. But anyway, now that it's working, we'll go ahead. So that's the common substance of our product. So we call ourselves Debt Plus Plus to differentiate us from Debt Plus, because we target 9 to 10% post-tax post fees as compared to debt plus products which target 7 to 8% post-tax post fees. But we're not equity enhanced. We may, in a few good years, do more than 10, 11, 12. But the framework is for about 10% post-tax post fees on a 12-month rolling basis. So with that, we will go into what we think and what the topic of today's webinar is. So the topic of today's webinar is Winds of Change, which was also the title of the newsletter that we put out 10 or 12 days ago. So as I mentioned, we believe our investment framework is sine curve, which is business cycles, market cycles, valuation cycles, etc. Last 4 or 5 months have been very volatile and non-linear. Sahil, you can move to the next slide. So this is just a slide on the track record. This is till May. I will touch upon how we are doing in June towards the end of the presentation to put things in perspective. But this is till May. So 8 months till May, or 7 months and 3 weeks since inception to the end of May, we were making gross of 15. Fairly consistent. Sharp ratio was very high at 3%. Standard deviation very low at 5.2. Some of that might change after this month, but we are still on track to do our 18% targeted for the full year. Sahil, next slide. So this is what we have been consistently saying for the last 6 months, that the markets will be non-linear. So what we mean by non-linear is not necessarily taking a call on the direction of the market up or down, but more importantly, taking a call on the volatility which is there in the market, which will be violent swings both up and down. That's one. And second, wide dispersion in terms of individual stock price performances, irrespective of whether the market is going up or down. So the chart on the left hand side shows Nifty since Jan. You can see how many up and down swings have happened, and all of them reasonably large and violent since January. The chart on the right-hand side shows the top 10 and the worst 10, Jan to today. And you can see how wide the dispersion is. So the top 10 is like 30% to 60% gain, and the bottom 10 are still -4 to -15, with fairly large names, right? So large names like ITC down 9, Asian Paints down 15, Unilever down 8, Tesla down 5. So these are not even small side names, which is showing this kind of volatility. So the non-linear markets are likely to continue for the rest of the year, despite the fact that we have seen a very, very strong June. One key feature of June, which is why we are thinking about winds of change in this month, is apart from being non-linear, this month, the speed of rotation within stocks and sectors have become even of a shorter cycle. So last 7 or 8 months, we have noticed that while the speed of rotation has been high, but it was more on a 2-monthly period or 3-monthly period, at least 3 weeks or 4 weeks. This month, what we are witnessing is stocks are rotating almost on a weekly basis. So 1 week, consumer stocks look good, they all rally 10, 12, 14%, immediately start cooling off the next week, then gets replaced by, let's say, private banks. Private banks was the last one to join the party in the last 1 week or 8 days. In between, IT did very well. It fizzled out, started to do well once again. Towards the end of this month. So the time cycle of rotation is becoming shorter and shorter. And typically this happens when the market participants have lesser conviction in what they were believing prior to such heightened volatility. So nobody is fully convinced with. So even the people who are playing, let's say, power and defense are not fully convinced at this point of time that power and defense would continue to rally for the next 6 months as well. People who thought IT services or chemicals will bounce back are also not fully convinced that they will continue to rally for the next 6 months. So every 6 or 7% gain, investors and the market people are taking money off the table, causing this volatility. Typically, this is accompanied by a rotation in the cycle of the winds of change. So what was working for the last year and a half may go into a consolidation phase for the next few months. What has not been working for the last year to 2 years could be the primary focus for the next at least 6 to 9 months, if not longer, because that is where the market is seeking slightly higher margin of safety, saying private banks haven't moved for the last 2 years, valuations have become reasonable. And with these reasonable valuations, perhaps that's the space to be as compared to chasing, let's say, ABB or Siemens. So uh, we have to get prepared for the winds of change in the market. I mean, our stance so far in the last 8 months has been pro capex, industrials, power and defense, and anti-consumer and FMCG. So there were four trends which were strongly in place in the last 8 months. One, PSUs were firmly up. Second, capex plays were firmly up. Third, consumption was down, and this was supported by very weak consumption numbers. Consumption was down. Fourth, IT services were looking very weak, and actually they are fifth. PSU banks were doing well, but the private banks were significantly underperforming. At this point of time, can you move to the next slide, Simon? So at this point of time, we are questioning all five existing market cycles. So, and we'll show some data to explain why. The chart on the top left shows BSE PSU index price to book. Now, BSE PSU index price to book bottomed out at around 0.7 in 2019-20. 0.7 was almost like bankruptcy valuations, where most of the people believed. I mean, if we talk to any large fund manager and recommended buying ONGC or BPCL or HPCL, they were trading at between 3 times to 5 times earnings multiple. They were trading at 0.6 to 0.7 times price to book. The usual answer used to be, but these businesses have no terminal value, so even a 0 P is fine. From there, the stocks bottomed out and turned, notching gains of 150% to even 400 or 500%. But at this point of time, the BSE PSU index price to book is at a decade high. It's not at the peak yet. The peak was in 2009-10 when it touched almost 3 times price to book. It's halfway from the peak right now, 1.6, 1.7 times. We are a believer in the PSU cycle from a longer term point of view. I actually believe that the PSU index can test 3 times price to book 2 years out, but no cycle is linear. That's the basic prognosis of sine curve, that everything moves in a sine curve up and down. Nothing is ever linear in a straight line. And it is perhaps time for a pause. It's perhaps time for a consolidation. It's perhaps time for a little bit of a pullback to take the froth of the milk, and then the milk starts boiling again. The chart on the top right, this is a cycle we are slightly less convinced with whether we will see a quick turnaround or not. FMCG volume growth has been very weak, as you can see on that chart, just slightly in the positive territory, 4 to 5%. The reason why we should also focus on whether this cycle can turn around is primarily because will the government turn a little bit populist with respect to consumption in this budget after slightly disappointing performance. So that's been the belief in the market and by some of the economists we talked to, that since BJP did poorly in regions which are more rural and more semi-urban, they are finally realizing that maybe they have not done enough to boost rural incomes and consumer demand. And if there are significant allocations made to that side, this space can turn around. It's also possible that BJP continues its path of trying to create jobs through capex and do a little bit of token commitment to this particular space. It's possible, but this space is also worth watching. The chart on the bottom left, we show how India's IT services is highly correlated to US services PMI index. And the US services PMI index is showing clear signs of inflection upwards. That's the light gray chart. And while Indian IT services business metrics at this point of time is not shown any improvement, it usually follows with 1 or 2 quarters lag. And most of the commentary indicates that at least the worsening has stopped. Valuations have corrected. This sector has underperformed for more than a year. Valuations have become more reasonable now. And any small sign of inflection of business growth picking up once again on IT services can turn this sector around. So we are positive, we are long positioned on IT services at this point. We have become very light on PSU stocks at this point in a long book. We used to be very, very PSU heavy till May. June, we have corrected that. The chart on the right-hand side shows relative price to book. We have taken 2 examples, one large private bank and the largest PSU bank, HDFC Bank and SBI. So this shows the relative price to book or price to book ratio for HDFC Bank and SBI. Peak was 5 times. So in 17 and 20, HDFC Bank's price to book was 5 times that of SBI. And right now it's at 1.5 times. HDFC Bank's price to book itself is at a 3-decade low. I mean, it's bounced off a little bit with 10-12% rally that we have seen in the recent past. But it's at a 3-decade low. And hence, even if long-term, our belief goes right that PSU banks will do well, there could be once again a mid-cycle rotation for a few months where private banks actually outperform PSU banks. So we are long positioned on private banks as well at this point. We are long positioned on HDFC Bank, ICICI, and Axis. We may even buy Kotak. We are watching it very closely. Sahil, next slide. So this is our classic sine curve framework. A lot of the thoughts that I've discussed so far, we have tried to put here. So defense, we are putting in terms of valuations, little close to the peak of the cycle at this point. We have done very well in defense names in the last 8 months. We book profits. We are out of them at this point of time. Same with energy, especially in NTPC and BHEL. We have done very well in the last 8 months. NTPC, we are out of. BHEL, we may actually consider going back in. We've been out for a while, but we may consider going back in. Pharmaceuticals, few of the names after long consolidation is showing signs of upturn, primarily DVs. That's our large pharma position at this point. We see NBFC valuations, particularly BAF, it's already come off from 10 times to 5.5 times. We see that correct a little bit more. So it's almost halfway down on its valuation correction cycle, but could go down a lot further. They could possibly be bottoming in chemicals. So that's one very interesting space. We don't have any chemical names yet on the book, but that's one space we are watching very closely. Agrochemicals look better than specialty, but specialty could also be bottoming out. This space has also seen more than 2 years of underperformance. So SRF, PI, Deepak Nitrite is on our radar to build at the right time. At this point of time, we don't have them. Similarly, in 2 discretionary names which have been consolidating for the last 2 years, I mean, consolidating is a mild word, which have crashed over the last 2 years, 40 to 50%, Page and Jubilant Foodworks. Both are good companies. I mean, the valuations are just sky high and the business took a little bit of a beating. We have traded Jubilant very well short in the past. Page, we tried to short in the past, but not such a great track record there because of its volatility. Both these names we are watching very closely. We don't have them on our book yet, but we are watching them very closely for a possible more concrete signs of turnaround. IT, as I said, I believe this is probably already past the bottoming because of the upturn in the US services ISM index. It's probably already past the bottoming, and we have started building positions. We are persistent in Tech Mahindra. We bought some Wipro today, hearing very good things about what Wipro is trying to do now under the new CEO. We might even add TCS. So tech, we are going long. Private banks, as I mentioned earlier, we have built long positions. FMCG, we are watching very closely. In terms of volume growth, best of the lot is Godrej Consumer, GCPL. We don't have it at this point, but that's the name that we are watching very, very closely. So this is a pictorial illustration of how we construct the sine curve universe, how we plot sectors and stocks on where they possibly could be in the cycle. And this is a cycle within a cycle, right? So here we are thinking 6 months to 9 months. We're not thinking 2 years to 3 years, because a number of sectors which are in a structural 5-year uptrend, like energy, defense, PSU banks, we are thinking at this point of time that they could go into a cyclical down cycle within a structural upcycle. So maybe 6 months, maybe 9 months, but in that ballpark. We are not